Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, John Zechner, chairman and founder of Zechner Associates, will be joining us for the hour. In 30 minutes, StatsCan will come out with the latest CPI data for the month of February. We'll be joined by Randall Bartlett, deputy chief economist at Desjardins, to help break down the numbers. And of course, we want to hear from you on First Call. Call us with your questions on North American large caps. We'll have John answer as many of them as he can at the end of the show. Number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. And of course, our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Canada is considering joining the Joint Expeditionary Force, a UK-led multinational rapid response military group, as it looks to deepen security partnerships. Defense Minister David McGuinty says the country is assessing potential membership, but is currently focused on rebuilding the Canadian Armed Forces. The review comes as Prime Minister Mark Carney meets with Keir Starmer in London. Defense cooperation and Arctic security are among the topics on the agenda. Shares of Meta are up in the pre-market. Meta Platforms, the tech company, has signed a major AI infrastructure agreement worth up to $27 billion US with cloud provider Nebius. Under the terms, Nebius will provide $12 billion in dedicated computing capacity starting in 2027, with Meta committing to purchase as much as $15 billion more as additional infrastructure is built. There are also reports the social media giant is planning layoffs that could affect 20% or more of the company. Alibaba is reorganizing its artificial intelligence operations as it pushes to generate more revenue from the fast-growing sector. The company is creating a new unit called Alibaba Token Hub, which will combine its flagship AI model, consumer AI apps, and AI products. The overhaul is designed to better coordinate research and product teams while boosting the commercialization of AI services. All right, now for our top line story. We, of course, are following new developments in the Iran conflict. U.S. President Trump is now openly calling on allies to help secure the Strait of Hormuz as shipping remains disrupted and oil prices remain elevated. Let's bring in our guest co-host for the hour, John Zechner, chair and founder of Zechner Associates, to get his thoughts on what is unfolding and what we might see. Off air, you just said, get ready for another fun week.
Yeah, well, it's Monday mornings always. You never know what the news is going to be over the weekend. It wasn't as much as I would have necessarily thought. I mean, obviously, what they did on Karg Island on, I guess, Friday was a little surprising, but that didn't really hit any oil facilities. But now, obviously, getting oil through the Strait of Hormuz is the key right now to what's going to happen in the oil markets. And they seem to not be able to get the security and the insurance and able to do it. And so Trump is doing what Trump does. He's sort of lambasting others and sort of trying to get others to sort of come on board and help him, get through this and get the strait open and get some pressure down, because obviously we know this oil price is going to be inflationary in the U.S. So, see where it ends up going. But I don't think necessarily. I mean, it's a big risk right now, given that there's still drones and bombs and other things, short-term targets, and that's such a narrow passage. It's very difficult to get through.
And how are you approaching it right now? Are you looking at it as short-term, or do you think this could go on?
Well, it seems to be going on longer than most people have expected, and it could, but that's the whole thing, Roger. I mean, it's hard to tell in the U.S. lately. It's like the trade policy and anything else. Trump is so erratic, and he can change in a moment's notice, and he's, somewhat vindictive on a lot of things. You don't know. He could turn around in a moment and suddenly, pull back, and then the oil price drops again. I think the surprise for the U.S. in all of this one, Roger, is that after Venezuela and after the bombing last June in Iran of the nuclear facilities and all of that, I'm sort of thinking they thought this was going to be easy. We'll do it there, we'll bomb a little bit, they'll change the regime, and we'll look great on this. And it's certainly not turning out that way. So markets seem to be optimistic a little bit right now. I think it's it's sort of a crowded trade. It was overowned and maybe due for a pullback anyway. But when you think of it, I mean, the S&P is only off, 4, not even 5% from the all-time high. That's not bad considering what's going on in the world and where oil prices are.
All right, we're going to pause for a second. We're going to bring in Tyler Kendall, who is standing by live in Washington with Bloomberg. Tyler, thanks very much for joining us for an update from Washington. What's the latest on this? How are allies responding to the president's demands?
Well, Roger, we saw over the weekend President Trump and this White House really intensify calls for the Strait of Hormuz to reopen as disruptions continue. And new this morning in a statement to Bloomberg News, a NATO official confirms that individual allies are talking with this White House about what more can be done, including in the context of reopening the strait. But at the moment, allies still remain very wary. We heard from the UK Prime Minister Keir Starmer earlier today saying that if there is an effort to reopen the strait, it will not be a NATO mission. We also heard from Germany saying it will not provide military support in the Iran war, saying that this has nothing to do with NATO. President Trump, as you know, told the FT over the weekend that NATO would have a, quote, very bad future if allies did not send ships to the strait to help secure safe passage of vessels, which really does continue what we have often seen between the U.S. and NATO when it comes to those tensions around military spending and boosting military budgets. And that's really not the only threat that we heard from President Trump to other countries when it comes to what is happening in that critical waterway. President Trump seemed to suggest over the weekend that he could delay his planned visit to China, set to start at the beginning of next month. If China does not send ships, I can tell you that data analyzed by Bloomberg Economics finds that nearly 38% of oil flows through the Strait of Hormuz do go to Beijing, but it appears increasingly unlikely that Chinese officials would send ships, in part because some of those vessels that are being able to traverse through appear to be heading towards Beijing, and they also have vast stockpiles. But Roger, within just the last few moments, we heard from the U.S. Treasury Secretary Scott Bessent in a television interview, seeming to suggest that if there is any delay to President Trump's highly anticipated visit to Beijing, it would not be over tensions related to Iran. It would be more because of logistical issues. So that's one to wait and see what happens there.
It is a complicated situation. Now, closer to home, I mean, I know in Canada here we're starting to pay, we're already paying enough for gas. We're starting to pay a fortune for it. What's the administration looking at to try and lower prices while the strait remains closed?
Well, this really remains the top political issue for the administration at the moment, because here in the U.S. we are careening faster and faster towards November and the midterm elections. We've already heard, of course, that the International Energy Agency is going to have that coordinated release. About 172 million barrels will come from U.S. stockpiles over the next 4 months. And then we also saw the U.S. lift some Russian-related oil sanctions on barrels that are already at sea. The administration also on Friday moved to invoke what's known as the Defense Production Act to spur some offshore drilling off the coast of California, though there are questions about how long it would really take to get that extra production online. But Roger, I spoke to the Interior Secretary Doug Burgum on Friday, who told me that he is leaving no stone unturned, in his words, and that the administration has a litany of options that they could invoke, including waiving what's known as the Jones Act, which would essentially let generally cheaper foreign tankers transport oil between U.S. ports. We could also see a push to get more ethanol content onto the market, and then also asking Congress for a federal gas tax holiday.
All right, Tyler, thank you for that update. Appreciate it. Bloomberg's Tyler Kendall. Let's bring John Zechner back in now. He's chair and founder of Zechner Associates. Talk more about this. They say politics makes for strange bedfellows. I heard Tyler there say maybe that Trump is calling on China to help out with this.
Yeah, that's an odd one, because when you think of it, China probably is the best able to get oil out of the Gulf, because they're Iranian oil, exactly, and they're not going to bomb their own tankers going through there. So that's a whole different story. Everything else, Roger, too, is a stopgap measure. I mean, the release from the Strategic Oil Reserve on a global basis of the U.S. I mean, U.S. is only at 21 days of supply, but I mean, even what they've put out there, which is sort of a third of the total inventory. If you're totally blocked the Strait of Hormuz, this is only 20 days worth.
Yeah,
so if this goes on, that's not going to help. New production measures in the U.S., that's not going to help. So, in the end, they've got to start getting oil through there. There's not a lot of alternatives. Otherwise, the price is going to go dramatically higher. And I think that's where the market will start to choke a little bit, because there will be inflationary impacts. And, certainly we're going to see it from the Federal Reserve meeting this week and all of that, they're not cutting rates in the face of all of this. So, this is Trump's war. The other allies aren't jumping in necessarily because they didn't start it. They didn't ask for it. So, they can
get... And they're trying to figure out how to dance in it, though.
Exactly, which is what they do with a lot of Trump things, whether it's come to capital spending or trade or whatever. Everyone's sort of talking the talk while he's still in charge just because of his personality, and they know he's very vindictive on these things. But in the end, I mean, there's no sort of incentive for anybody else to get that closely involved, because, it's his decision in the end what they're doing there.
And what do you, just quickly before we head to a break, Bank of Canada also, there's a bunch. European is reporting, the Bank of England reported. What do you think we'll hear from them this week?
I think they're just stay pat, stand on the sidelines. I mean, inflationary pressures, we'll see, Canadian inflation numbers this morning, but inflation is still relatively elevated. There's oil prices and helping. I mean, the economic data has been soft. We saw the Canadian employment numbers were, on the U.S., both of them are very soft recently. So we know you got the weakening on that side, but with the higher oil prices, it's probably a stand pat for most of the central banks.
Okay. Yeah. We'll leave it on that note there, John, but we've got lots ahead. When we come back, we'll dig into it is really behind the recent pressure on tech stocks and what the sector's rotation means for the broader market. All right, tech has been under pressure as investors rotate into defensive names. Let's bring back John Zechner of Zechner Associates, who says this sector is still the engine of corporate earnings, and this pullback could be a chance to add.
Yeah, we're sort of laughing in between.
There's always an opportunity in crisis, right?
Yeah, and we're sort of saying don't throw the baby out with the bathwater is the old line. Because, I mean, this market was overbought. I mean, you had highest level ever of U.S. equity ownership or equity ownership in the stock market. Most of that was in the technology sector. Yep. Passive as well as active, because we knew it in the indices had ridden up so dramatically. The large 7 stocks were almost 40% of the index. So it was just too heavy. It needed to, go down. And as people are sort of unwinding because of everything that's going on now, the slower economy, the worry about rates, obviously the geopolitical and everything like that, they're getting out of stocks because they can't really handle the risk. So they're selling the most liquid things that they're heaviest in, which is technology stocks. And I think the mistake you can make is sort of saying this trend of the past 6 months is something that will continue. And I don't think it necessarily will. Like I'm careful to watch, this is not a repeat of 2001 or something like that. It's sort of the end of tech for a long period of time. I think it's a different story. When you look at tech, is still driving the overall corporate profitability growth. I mean, so the back of the envelope numbers I was doing recently is you sort of take tech out of the equation. You can knock earnings growth in the U.S. basically in half. You can knock 6 percentage points off in the past year. This has been sort of the source of all growth. The stocks were overowned. You're creating opportunities. And when you start to get these big behemoths that are continuing to grow, and I think they will grow faster than the rest of the market, have suddenly come down from overvalued to, moderate market valuations, I think you got to buy them. And you know what? A couple stand out. Microsoft down at these levels. I mean, you can buy Microsoft now, sort of 22 times forward earnings, which is a market multiple. That's a good deal. And we had sold a name like Oracle last fall because I was worried about the valuation. It was 40 times earnings. Yes, they look strong with the OpenAI orders in cloud AI infrastructure and all of that, but it was a negative free cash flow for a number of years. Now I'm looking at it, the stock's been down 50% over that 6-month period. Great earnings last week. They're continuing to grow in that area. And now I'm looking at it, sort of 22 times forward earnings. So, Roger, I just think I don't think this is a long-term shift into the cyclical industries that you need to chase necessarily. You have those weightings, but I think some of the best opportunities are actually being created in the tech sector. And, how obviously software is blowing up. I think there's great valuations there.
And we've heard that a few people say the death of software is greatly overrated. What kind of a factor does the geopolitics play into this? So, people are looking what's unfolding. Will that keep them away from tech, or will that maybe push them back toward it?
In terms of the fundamentals of the industry, that's sort of the good thing, is that tech is sort of unaffected by this. In some ways, you've got to, given some of the hacking and other things on an international basis, you've got to increase your cybersecurity and other things. You're going to spend more on AI. You're going to spend more on infrastructure. You need the data communications. So in some ways, yeah, I don't think tech is impacted by the geopolitical risk to the degree the rest of the market is. The risk is, like I say, it's a crowded trade. It's overowned. And these things always overshoot on the upside when everyone's loving them, which they did.
Yeah.
And they often, overshoot on the downside valuation-wise. I think that's what you're doing now. So I don't know that it's at the bottom, but you're creating these great opportunities. When you can buy, Adobe and Salesforce at 10, 12 times earnings, these companies are not finished growing. And those are just great valuations.
Could AI tech and tech stocks, could they almost become a defensive because everybody needs them and you can't get away from them?
What defines a growth industry is taking an increasing part of overall GDP. And when you look at it, this will continue as they need to continue to spend more and more in technology. So it's a greater share of gross national product. That defines a growth industry and that defines technology. So absolutely, yes.
And what kind of headwinds could there be? What would be a headwind right now that you think?
Well, you get things like, DeepSeek news last year. Suddenly AI models come out so much cheaper. You get, what competition from China. Other things, higher interest rates, because these are sort of long duration assets and the valuations always come lower if you get higher interest rates from, higher inflation. So there's always those risks. But I think overall, the growth of the industry is going to continue for a number of years. And to me, it will beat the growth in a lot of other consumer and industrial product and other areas of the market, which means if you get those stocks at similar valuations or lower than the rest of the market, you should be buying them.
And is it across the board or do you need to hunt?
I think you hunt a little bit because I think the big move has been in the build out of the infrastructure, the large language models, obviously data centers and semiconductors and that spending. But I think what software is showing you, Roger, is that the market looks so far ahead. Once the growth starts to come down a little bit, like we saw with software, people get very worried and they price it down. So CapEx this year has obviously gone higher and higher for the last couple of years. But it's going to peak pretty soon. They won't continue to spend at this rate or at growing rates of that. Once that peaks and starts to come down, what happens to these semiconductor valuations and the stocks? And I think, NVIDIA is telling you that a little bit. The fact it hasn't really moved through that all-time high for over 6 months now. Yeah. Besides, blowout earnings and everything else. I think, this story, that part of the story is maybe peaking, and the implementation and use, which, comes back to the software as well as, the hyperscalers, the Alphabets and Metas and, Microsoft as well will be the beneficiaries.
All right, we'll leave it on that note there, but lots more to talk about coming up. When we come back, we'll dig into Canada's big six banks. Strong results on the surface, but valuations are still running hot. Canada's big six banks posted strong results, but with valuations still elevated and loan demand softening, the sector is looking a bit stretched. We're back with John Zechner of Zechner Associates on his thoughts on that and why he thinks they are a bit stretched. What has you having a close eye on?
It's simply valuations, Roger, and that's really all. Because, I know everybody loves the banks. They're, over 30% of the index of financials are here. The banks are, a good chunk of that, and everyone's got them in the portfolios, and they own them for dividends, and they've been fantastic performers over a number of years. So nobody's going to sort of be without them in their portfolios to a complete degree. But I just started to look at them and said, what's the upside in the short term right now? They're trading at over 14 times forward earnings. And maybe, we're looking to a new level of elevated valuations ad infinitum. I'm not sure if I'm buying that, but over 2 times book value, which book value matters more in the financial industry because it's the hard value of your assets. The dividend yields are not as attractive as you can get in, telecom and utilities and pipeline, things like that. I think the dividend yield right now is around, 3.5 or 3.6 overall. So I think, it's a good story long term, and they've done well. But, what's sort of driving the short term? Loan growth has slowed down. They still got risks, obviously, from loan loss provisions. And the biggest tailwind has been capital markets.
Dropped there for, I'm trying to remember who, but at least one dropped their expected losses this year.
Oh yeah, no, I think Scotia and RBC sort of upped them a little higher than expected. Everybody else was lower than expected. I think on that one, Rogers, everybody was expecting a lot more damage to the economy, from a year ago when you think of it, obviously because of the trade war, and those issues haven't gone away necessarily. No. They just haven't crystallized in this period, so they didn't have to take the provisions. But Scotia was probably the one that they moved up to 60 basis points in terms of overall loan loss provisions. I think TD was down at 30 basis points or something like that. So you're right, it was a huge difference between what their loan book looks like. So I mean, yeah, you're out of growth too. I mean, the consolidation is over in the sector. I mean, with Canadian Western Bank gone and Laurentian Bank, I mean, there's no big things left to buy. So they've already, they sort of failed going internationally, particularly into the U.S., and the opportunities aren't there.
But they're out internationally. You don't think they can try again?
I don't know. It's harder on a regulatory basis, particularly in the U.S., which is the most natural one. Are they going to turn around and start buying European banks? I don't think so. Scotia showed they had a harder time in Latin America, and they're sort of, retracting on a lot of those bets. So, they're hitting the domestic economy, but they already own the domestic economy in terms of banking. Mm-hmm. And I think they're a little bit more at risk longer term as well from incursion from electronics and other things like that are sort of going to cut into their sort of highest, most profitable fee businesses, ETFs into some of their money management side and all of that. Obviously, the tailwinds of the strong stock market and everything has been good for the capital markets division. So there's a lot of things that have worked for them. If those don't work going forward and don't grow as much, when you got the elevated valuations, where's your upside? I don't worry about them collapsing. They've already gone through, the financial crisis and everything else and held it very well. But I thought, where's your upside versus, we're just talking about tech and the last thing where I see lots of growth still.
Is there one more vulnerable than the others?
They're pretty uniform at a lot of their structures right now. Yeah. So, I'd say that probably the safest is still RBC, and the premium valuation has disappeared a little bit. So if I could take one, I'd probably stick with that, stick with that with the top one going forward. So.
Hey, so what are you doing? Are you pulling out from the banks? Are you taking some out from the banks, or are you just kind of?
I just got a low weighting. I've got, like I say, I've probably got 5% of, which is very low equity-wise. I've added some life insurance companies recently. Manulife looks interesting on a valuation basis. Bank life companies compared to banks, and then there's just a lot of other things. I've seen better opportunities. Obviously, energy lately. The gold. Talked about the beaten-up technology sector. I think telecom stocks are cheap. Some of the pipelines still look good. Energy infrastructure, defense spending. A lot of areas. So the banks don't sort of make the top of the list right now for me.
Okay, and for dividends, which one of those are you?
Telecom stocks stick out as probably the best dividend. Telecom and pipeline really have the highest dividend yields at a reasonable valuation.
And they're holding right now?
They're holding fine, yeah. So if you can hold those for the dividend yield, and you're getting way more than you're going to get in the banks right now on a yield basis. So.
And with the pipelines, what are you seeing with them? Like, do you see Canada benefit? Kind of everything comes back to oil, doesn't it?
Yeah.
Go ahead.
There's infrastructure spending there, and it'll continue. And, obviously trying to increase the liquids. And then with, new ports, you're talking about, what Carney's projects going forward all require, the transportation of oil and gas across the country, more east-west basis. So, they will benefit from that. So, they'll grow, and infrastructure and the spending will continue on that basis. So I like the pipeline stories. I mean, there's even, Sobo has been acting well lately because someone was able to start up Keystone again. Well, I don't know if I'd roll the dice on that one, but who knows?
They're right now. And we're almost out of time, but the telcos?
Telcos are so out of favor and so unloved, and yet they're so cheap. So, they've not worked out well for the past couple of years, but I'm a long-term player in this one. I can take the pain. For now, I think the valuations are cheap. You're getting a good dividend yield while you wait. And to me, they're infrastructure assets in a growth industry. So, I continue to like them.
Okay. We'll take a break on that note there, but still ahead, we're breaking down the numbers from Stats Canada on the February CPI data, and our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email, firstcall@bellmedia.ca. Stats Canada has just released the latest Canadian CPI data for February, and the Consumer Price Index rose 1.8% on a year-over-year basis in February, following a 2.3% increase in January. downward pressure on growth and consumer price index with the GST, HST break ending in February of last year, and the broad-based year-over-year deceleration in grocery prices led by beef products behind this. So for some more reactions, some in-depth analysis, we're going to bring in Randall Bartlett, Deputy Chief Economist at Desjardins. Randall, thanks very much for joining us.
Oh, thanks so much for having me.
The numbers, you're looking at them, a little below what people, I think what the consensus was, but are they in line?
Yeah, I think that's the takeaway, is that the outturn today was broadly in line with consensus expectations, but a little bit south of that. And so entering this period of high energy prices that started at the end of February and into March, really, we saw inflation below the Bank of Canada's 2% target. And, that follows that weak labor market print we saw last week, too. And so certainly, a lot for the Bank of Canada to think about as it, announces its rate decision on Wednesday.
Yeah, Randall, that was sort of the point I was sort of wondering we're going to bring up, because the Bank of Canada has really been saying we're going to stand pat. I mean, they're at 2.25 versus, the U.S. 3.5. The spread is pretty tight. But I mean, we've had the inflation numbers now under 2%. Core is coming down a little bit. Then you had the really awful employment numbers last week on top of that. And then you still got all the trade discussions going forward. So I know what you're saying about the energy wild card, but do you think there's going to be any leeway for the next Bank of Canada meeting that they maybe talk a little bit more dovishly, or do you think they continue just to stand on the sidelines and they're, more data dependent and they're at the right place right now?
Yeah, I think data dependent is really the key term there, because if the Bank of Canada was making its policy decisions based just on historical data, then certainly I think it would continue to have a bit of a dovish bias going forward, as we have this weak data historically, and then now we're going to be moving through the CUSMA joint review, which comes to a head on July 1st of this year, and so really a lot of that sort of risk to the economic and inflation outlook is tilted toward the downside. But then you have to layer on the Iran conflict and the oil price shock that we've seen, the rise in gasoline prices, transportation costs, supply chain disruptions. And so that's really thrown a lot of uncertainty into the outlook for the economy, for inflation, and for monetary policy. And so it's really going to be a balancing act, I think we see on Wednesday, where the bank acknowledges this upside to inflation while also acknowledging where the downside risks are. And so we think the bank is going to stay on the sidelines and really sort of take a balanced approach in its outlook for monetary policy, and really wait to see how things evolve going forward as we move into April and we get a new projection and a more fulsome analysis with the monetary policy report.
I was going to say, would this number have mattered more if what was going on, if it was all peace in the Middle East right now? Is this kind of do we almost dismiss this to a degree, and it's more important that we look forward to the numbers for March?
Yeah, I don't know if we can dismiss this entirely, because, this is really a snapshot of where the Canadian economy would be without this external shock to the outlook. And so, when we get the March numbers, that's going to impact total inflation. But it's really going to take time for it to feed into underlying inflation, into, ex-food and energy, the bank's preferred measures of trim and median. And so those measures are really showing us continued slowing in inflation and underlying inflationary pressures. And so it's really, I think the Bank of Canada, if this is going to be a temporary shock, if that's how it views it, it will largely look through this. It really, I think, matters how sticky this energy price shock is going to be. Now, the longer it's around, the more it'll feed into inflation expectations and underlying core inflation. So I think that's going to be part of that wait and see approach by the bank, is to see how long does this conflict last? How long does the shutdown of the Strait of Hormuz last? And so how long can we expect this to be a factor in terms of underlying inflation?
Forgetting the Bank of Canada for a second, I keep looking for a trade at the long end of the bond market lately, because the structure of the yield curve sort of really surprised me. You had short-term rates in Canada at 2.25, and you had the 30-year Canada touching, almost at 4% the other day. And I keep thinking, that's quite the spread. And I thought, especially with the weak employment numbers, the risk from, like you say, the renegotiated the trade agreement and all of that. And I try to understand why, especially with core inflation coming down. Do you think that has more to do with the increased fiscal spending and the demands there, or is any reason? What do you think will be the trend in longer term rates? Because that seems to be the end that's really sticky right now.
Oh, absolutely. And our macro strategy team at Desjardins does some great work looking at what's affecting term premium in Canada. And what they've determined is that it's really a factor of global forces that are driving up the term premium, not just in Canada, but across the world. And a lot of that we're importing from the United States, where you're seeing record deficits, you're seeing significant issuance, you're seeing inflationary policies, whether it's the conflict with Iran, whether it's tariffs, or whether it's pressure on the Federal Reserve to bring interest rates down more aggressively than it is already. So you're seeing this very pro-inflation policy south of the border. And all of that higher term premium stateside is spilling over to the global bond market in Canada as well. And when we look at domestic factors, one of the more interesting things we're seeing is that there is increased appetite as we're seeing greater diversification of global investment flows into Canadian fixed income, whether that's Government of Canada, provies, or corporate bonds. And so we're seeing a lot more interest in Canada because it is highly rated. And ultimately, Canada is one of the cleanest fiscal dirty shirts in the laundry basket, given our level of deficit and level of net debt, not just at the federal level, but broadly across all levels of government.
All right, I'm just going to bring it back for one last question to the data itself. Is there any one section? I was looking at the fuel prices, slower growth for cellular. Food, though, restaurants, I think, saw a 7% jump. Is there anyone that jumps out at you of any of these numbers?
Yeah, I think part of what's affecting these numbers too is the fact that the GST HST holiday ended in mid-February of last year, so we're still picking up some of that distortion coming through in the data. But everything we're going to see in underlying inflation, in particular, from here on in, is going to be relatively clean, and also in terms of food inflation, which was the most impacted factor by that GST HST holiday a little better than a year ago. And so I think now that that's coming out in the wash, we're going to get cleaner reads on core inflation as well as inflation excluding indirect taxes, and that's something the Bank of Canada's really honed in on in recent months. Oh,
all right, Randall, we got to wrap it up there, but thank you very much for joining us.
My pleasure. Thanks so much for having me.
Cheers. Randall Bartlett, Deputy Chief Economist at Desjardins. Still ahead, we'll take a look at the markets before the bell. And, of course, our phone lines are open. John Zanger's taking your questions on North American large caps. Call us at 1-855-326-6266. You can also email us, first call at bellmedia.ca. All right, let's see how things are shaping up on the markets. We will start with the U.S. futures, and the risk-off continues, but they're liking probably some numbers they're seeing today. Look at that change now. At one point, they were off earlier. Now, bouncing back on the plus side as we head into a new week. See what their optimism rests on. Heading to Asia, and a mixed bag there. You can see the Nikkei off slightly, 0.13%. Hang Seng up by 1.45, and the CSI 300 pretty much a wash. They are watching for the central banks there, Japan announcing major policies this week. We'll see what happens there. Heading over to Europe, Iran and central banks again. Key factors, the Bank of England, European Central Bank reporting this week, so we'll get some commentary from them. First one since the Iran war, and you can see people are a little more optimistic in Europe right now. It's FTSE's up 0.62, CAC 0.21, and the DAX up by about a half point. Looking at the TSX, had its worst day in about a month as we saw a rotation into defensives. It was off by 0.91%. Let's see what some of the movers and shakers were. Not much shaking on the positive side. Empire up 3.9, Bird Construction 3.8. Now going the other way, First Majestic Silver, a roller coaster for silver, down 7.88, and Methanex off by 10.16. And looking at the metals, gold trying to stay above 5,000 right now. It's off by 0.7%. We'll see it drop below that in a little while, and we'll see what silver's doing. It's up by 1.6. It's hovering around 80. May dip below 80, and copper up today, 0.73, but down about 5.8 for the last little while. Western Canadian Select had another up day, but the discount tightened on Friday. It was up about 2.8%. And WTI right now is off 3.2% at 95.5 for a barrel. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including Marin Energy. Let's take a look at some of the notable analyst calls and recommendations. Marin Energy, formerly Africa Oil Corp, has been cut to hold at Fernley with a price target of $2.32. Marin has been navigating a volatile period with recent 2025 results highlighting a mix of operational, financial, and strategic updates. ServiceNow has been raised to outperform from neutral at BNP Paribas with a price target of, you can't say that word today, US $140. This move comes as part of a renewed positive view on SaaS valuations by BNP Paribas analysts who cited resilience and potential upside for ServiceNow amid a complex AI landscape. Well, the crisis in the Middle East continues to push the price of gas up in Canada. It's also prompting EV advocates to talk up the benefits of diminishing our reliance on oil. CTV Quebec Bureau Chief Jean-Pierre Beauchemin has more.
Those in EVs bypassing the gas station avoid this sticker shock. A liter is now hovering around $1.88 in Montreal.
I've been aware of the price of gas. I haven't been watching it because I don't have to.
And how does that feel right now?
Pretty good.
The electrification industry says the latest oil crisis serves as a reminder that volatility is part of the gas game. Not so for cheaper power. And Electric Mobility Canada says those looking to buy Canadian should consider what they put in the tank.
More than 70% of the oil sands are owned by foreign companies. And the vast majority of electricity production is owned by Canadian utilities.
But that may not seal the deal for many car buyers. After all, critics say the high price of oil is cascading throughout the economy, where EVs are still a pricey bet.
Even if you drive an electric vehicle, it's going to impact the cost of pretty much everything, including the building of those EVs.
That has some pushing other solutions that have nothing to do with EVs, including government-issued rebates to make up for higher gas prices. This as the latest Statistics Canada numbers show new zero-emission vehicle sales slowed 36% from December 2024 to December 2025. EV advocates, though, say they see early signs of a reversal in that trend.
The future of the auto industry.
A February announcement of a return to federal EV rebates could be giving the industry a boost, say advocates. To Gilbert Bouc, no pain at the pump is an added benefit.
At one point, I was not sure, is it really worth it or not? But for the price of the gas now, I guess it's worth it.
Now, it's not clear just how long this volatility will last and whether indeed it will be part of the decision-making when it comes to EV purchasing. Geneviève Beauchemin, CTV News, Montreal.
When we come back, John Zechner will take your questions on First Call. All right, time for First Call and first email. This one's from Lori. Good morning, John and Roger. Your thoughts on Air Canada? It's sinking since the war with Iran started. Will it continue to sink before a rebound? And you think it's undervalued at current pricing, looking at it for a potential swing trade?
Well, they've got a lot of headwinds right now, unfortunately, because, like I say, the international travel is down. There's a lot of, destinations they can't go to. They've already had to rework it in the past year. Because of the U.S. and they've redone that. I mean, Mike Russo, I know, who's the CEO, and he's done a fantastic job guiding them through the pandemic and everything else. The balance sheet is far stronger than it's ever been. But in the short term, you got these major headwinds, like your fuel costs are obviously a huge input. And, the travel restrictions internationally, as well as, the reduction to the U.S., it's going to be tough for the next couple of quarters. So I still, it'll be all right ultimately, but I don't know if I jump on it, too quickly, because it's going to go through, like I say, a lot of permutation short term.
Yeah, there's still a lot of unknowns for it too, right?
Absolutely.
I mean, I imagine the U.S. was one of their big destinations, and
they repositioned that, and changing sort of the load factors and the destinations. People more to the islands and other places. But as you and I were talking about, U.S.-Canada relations, that's a hard one to unwind. It's so integrated, and it's decreased, but it's not going to disappear altogether.
No. All right, we got a ton of emails. Let's get to that. Oh, sorry, we got a caller now. Murray, how are you?
Good, thank you. Best business program on television, by the way.
Oh, cheers.
Thank you for taking my call. My question is, Constellation Software, they had a good report, good conference call. They had briefly touched 3,000 after, now it's retraced to back down to 25 and change. Do you think the worst is over, or this is really kind of a crazy story this year? I can't figure this one out. But thank you very much for taking my call. I'll hang up and listen. Thank you.
Yeah,
All right, cheers, Murray.
Sorry, I think that's an opportunity to get on. It did pull back from the 3,000. There was some specific news the other day about one of their particular companies. But I think when you look forward, the earnings report was good. Mark Leonard is still doing this new strategy of maybe investing partially in publicly traded companies as well. But they still buy into private companies, and I think the valuations they have strong free cash flow, and I think they're going to be accelerating because right now this is sort of a buyer's market, and they are buyers always. So I think they'll be spending over 100% of free cash flow, which they did last quarter, continuing to make these acquisitions. And the other thing is, like, some of their competitors have been private equity of their own issues right now. So your competition has gone out a little bit. The valuations, which I always had a difficult time with when it was mid-20s times operating cash flow, now you're looking at 12 times operating cash flow. The inherent vertical market software integration continues. They will continue to do these binds, and you're getting it at a more reasonable price. So yeah, we've bought it recently, and around here, I'm fine to add a little bit to it. So.
Not concerned the possibility there might be fewer software companies to buy, so they might be struggling to buy companies?
Well, I think they're going to get them cheaper, and there will be more. You'll have to get out, and the valuations come down, which plays right into their, bailiwick, because they have the free cash flow, so they have the ability to buy it. And like I say, there's fewer competitors buying against them right now. So.
All right, let's get another email in. This one is from Dave. Would you buy FFH at the current price?
It's still a premium valuation, so I would say no. I mean, people think of it as sort of Berkshire of the North, and maybe it is to a great degree, and Prem is a great long-term value investor, but you're still paying a bit of a premium for the assets. So you look at it as an insurance operation, not as Berkshire too, and a great asset play necessarily.
All right, that sounds like the end of the answer right there. Okay. Another email from Mike, and looking to get your guest's view on Google. Thanks.
Yeah, no, I like the hyperscalers right now. When you can get stocks like this at close to a market multiple, I mean, Gemini has been a great success, and that's given them more of a premium valuation over the past year. But I think these guys, one of the biggest beneficiaries of AI is going to be guys who can sort of use it to do mobile advertising and other things, and sort of pass through to the clients and get enhancement from that. So I think the biggest productivity gains are going to be through these cloud infrastructure plays, like Alphabet. Really the big public clouds, they're Alphabet, Amazon, and Microsoft. And I think these will be major beneficiaries with this, the AI spend. They've been upfront on the spending. I think they'll be upfront on the benefits and the productivity gains as well to their customers on the public cloud. So at these valuations, if you own it, stick with it. And plus their ancillary assets are fantastic. Hey, a couple of years, the Academy Awards are going to start here, be just on YouTube only.
I know, that'll be interesting. The little slam they did yesterday during the Oscars. Now, can all of them win, do you think, or is there room for all of them to win?
Well, I think for now, I mean, I think cloud is growing, and I talked about growth industry. The market shares may change, but when you look at what the growth rates are, you're still 30 to 40% for each of the public clouds. Now you've got obviously Oracle coming in as maybe the AI cloud provider, so they've got more of a growth runway at that point. So, but yeah, I mean, everybody's moving to the cloud. I mean, we shifted our whole business right from backroom servers to Microsoft Azure about 2 years ago. Yeah. Smooth transition, cut my costs down dramatically. I mean, and suddenly all these issues that we had before are their issues. So, all right. Great.
Okay, got to get in a couple more emails if we can. This one's from Maggie. Are gold mining stocks a buy at these levels? If yes, which gold mining stocks look attractive?
I think they are, because I don't think gold stocks are reflecting anywhere close to $5,000 right now. When you look at the cash generation the last couple of quarters, where you're looking at still $3,000 in price, I think the gold stocks are still a good buy. Top of my list was take the geopolitical risk out of the equation, so focus more on North America. Torex Gold with the Morales property in Mexico, and great transition to the Media Luna property or mine on that property. We're a great cash flow generator, discount net asset value about 4 times operating cash flow. And Barrick actually is looking interesting again for the first time in a while as a domestic play.
All right, classic name. We're going to get one more email in. Boy, we've jammed them all in here. This one's from Margaret. Which pipeline would you recommend at these levels? We talked about it briefly.
Yeah, Pembina was sort of my favorite choice for a while because there was such a discount to Enbridge and TC Energy. They've all gone up recently. Pembina has closed the gap a little, but I think I would still stick with it. It's got a higher dividend yield, it's slightly lower valuation, and I think it's probably got more growth potential than the others to expand, especially, from the base going, West Coast, and the additional lines. So I think there's more potential for Pembina to expand their earnings, grow their cash flow, slightly higher dividend yield, slightly lower valuation than TC Energy or Enbridge at this point. So.
All right, John, we'll wrap it up there. But thanks as always for joining us.
Yeah, Roger.
John Zechner, and the Open is up next. Joining us at 9:15 will be Mirko Bibic, CEO of Bell Media. So stay tuned for that interview. And that is it for us on the street. Again, thanks for John and joining us today. A little bit scattered on a Monday morning. Holy cow. Trading gets underway in about 30 minutes from now. Have a great day.